Hi, I'm Ali from FX Cards. In this video, I'm going to show you a very simple way to perform technical analysis. I'm going to show you how to set up your chart, how to execute one simple trade setup, and then how to manage your risk effectively. Over the next few minutes, we'll cover 3 essential tools, a precise entry method, and then a position sizing approach that you can apply immediately. Just a reminder that Forex trading is risky and that most traders lose money. This video is for educational purposes only. So what is technical analysis? It's basically the discipline of reading prices on a chart. It focuses on how price is moving, how quickly it is moving, and then where it tends to turn. One important thing to note is that it is not an attempt to predict the future. It is simply a framework for making decisions. And this framework is very simple. First, you'll identify the trend. Second, you'll mark the key price levels where buyers or sellers have shown interest before. And third, you'll wait patiently for a valid signal at one of those levels. And throughout the process, of course, you'll manage your risk from the beginning rather than as an afterthought to the process. Now I want to cover the 3 building blocks of technical analysis. Firstly, we'll cover trend and market structure. This is always where you start. Trends reveal themselves through market structure. So in an uptrend, the chart prints a sequence of higher highs and higher lows, and in a downtrend, it prints lower highs and lower lows. To make this easier to see, you can add 2 moving averages to your chart. The 20 period to capture short-term flow and the 50 period to capture the broader direction. A simple moving average is steadier and it takes into account all price action equally, whereas an EMA or an exponential moving average counts the most recent price action more heavily. And you can use either one, but use the one that you find easier to read. I like to use an EMA. So when the 20 period sits above the 50 and both averages slope upward, you will maintain a long bias or you would buy in a long direction. And when the 20 sits below the 50 and they both slope downward, you'll maintain a short bias. And aligning your trades with the dominant direction means that you'll reduce avoidable whipsaws. The next part of our technical analysis is support and resistance. Support is a price area where buyers have repeatedly stepped in, and resistance is a price area where sellers have repeatedly stepped in. Now, you'll draw these as zones rather than single prices because real markets often probe slightly above or below before deciding whether they're going to respect that support or resistance. These zones organize your plan. They point to where entries would make sense, but they also show you where you can set your stop as an area where your trade idea doesn't make sense anymore. And they also suggest where targets should be set at the next logical area where the price might turn around again. Our third tool helps us to identify momentum or how fast the price is moving. That's the RSI. So the RSI set to 14 periods, which is the default, measures recent speed and strength on a scale from 0 to 100. And rather than treating 30 and 70 as automatic triggers, you use the RSI to confirm momentum after price has pulled back to a certain level. So in an uptrend after a pullback into support, look for the RSI to turn upward to show that momentum is realigning with the trend. And in a downtrend after a pullback into resistance, look for RSI to turn downward. This simple confirmation helps you avoid trades that are too early or too late. So let's get into the chart setup and how you put these tools together. Firstly, you want to keep your chart as uncluttered as possible and you want to use candlesticks only. You'll add the 20 period moving average and the 50 period moving average. I'm going to use an EMA. You have to adjust the settings from a 9 to a 20 and a 9 to a 50. Then you're going to add the RSI and set it to 14. And if you're starting out, I would use the 1 hour and 4 hour charts because these timeframes reduce random noise compared with very short charts, but they still provide enough activity that you don't have to wait days in between for your signals to occur. So before I get into a trade example, I just want to do a quick shout out to our sponsor Vantage. We've been using their mobile and desktop apps and we've been very impressed. Their ProTrader powered by TradingView keeps all our workflow in one place with familiar charts, with all the indicators that we usually use, and 50 plus drawing tools. It's also more than charts. It offers analyst views, featured ideas, technical insights, market buzz, and a time zone aware economic calendar. This is really great for idea generation, for confirmation, and for staying ahead of events without having to leave your chart. You still have MT4 and MT5 if that's your playbook, And it offers in-app copy trading so that you can mirror the strategies of other more experienced traders. As a beginner, you can start risk-free on a demo account with $100,000 in virtual funds. And then you can go live across 1,000 plus instruments, including Forex, indices, commodities, shares, ETFs, and more. Then if we look at their pricing, they also really shine on this level. Their raw ECN account has 0 pip spreads plus a commission of only $3 per standard lot per side, which is extremely low for the industry. And of course, we would never recommend a broker that's not regulated and trustworthy, and Vantage is regulated by multiple entities across the world. So if you want more information, please scan the QR code or click on the link in the description below. Now let's get into the setup. So the setup that we'll use is a 20/50 pullback to a zone of interest. And it works based in liquid Forex pairs like all the major pairs, the Euro USD, the USD JPY or the GBP USD. And it also works well on major indices. So for a long trade, you'll follow these steps. Confirm that the 20-period moving average is above the 50-period moving average and that both averages slope upward. Wait for price to pull back into a clearly defined support zone that is held at least twice in the recent past. 3 times is actually better. When price reaches that area, look for a strong bullish rejection candle that forms near or above the 20-period moving average. So these are bullish engulfing candles or hammers, for example. At the same time, check that the RSI has turned upward from roughly the 40 to 50 region, which indicates that momentum is recovering in the direction of that trend. You'll place a buy stop just above the high of the signal candle so that you only enter if price actually confirms by breaking that level. You'll set your stop just below the most recent swing low or just under the support zone. You'll plan your target by measuring the distance to the next resistance area and confirm that it offers at least 2 times your risk. For a short trade, of course, you'll invert that condition. So you'll ensure that the 20-period average is below the 50-period average and that both averages slope downwards. You'll wait for a pullback into a resistance zone that has rejected price at least twice. You'll look for a clear bearish rejection candle near the 20-period moving average, so a bearish engulfing candle, for example. And you'll confirm that the RSI is turning downward. You'll place a sell stop below the low of the signal candle. You'll position the stop above the swing high or just above the resistance zone, and you'll ensure that the next support area offers at least 2 times your risk. Now, to make decisions consistently, move through the same sequence every single time. It should be quite mechanical. Start by asking whether the chart is trending, and if so, has it moved back to a meaningful zone? If it has, ask whether a valid signal has formed, and then look at whether the RSI is moving in that same direction. Finally, you'll calculate whether the distance to the next levels offers a meaningful risk-reward ratio of at least 1 to 2. If any of these answers is negative, patiently wait for the next opportunity. I just want to quickly get into risk-reward ratio. So the risk-reward ratio compares the amount of dollars you stand to risk versus how much you stand to gain in any trade. If you risk $100 to make $200, your trade is a 1 to 2, often called 2R. I spoke about position sizing earlier, and position sizing is very important to keep your account intact. Most traders risk no more than 0.5 to 1% of their account on each trade, and that is to ensure that if you have a losing streak, you don't blow up your entire account. And by planning your stop beforehand and planning how much you plan to risk on a trade, you are turning uncertainty into a controllable variable. I want to quickly cover some common beginner errors and how to correct them. Many beginners chase price when they are far away from moving averages and when they're not in any meaningful support or resistance zones. The remedy is to wait for a pullback into a zone and require a clear signal with RSI confirmation before entering. Another common mistake that beginners make is to draw support and resistance lines as razor-thin lines. Real markets rarely respect a single price, so treat these as zones and expect occasional overshoots. A third mistake is entering without a risk plan. First, decide on the dollar amount that you're willing to risk. Place the stop where your idea is invalid. Size the position accordingly and keep the stop where you planned it. Finally, many beginners focus on win rate alone. Track expectancy instead, because the balance between your risk-reward ratio and your win rate actually determines whether your approach is viable. Thank you so much for watching. If you enjoyed this video, please give us a thumbs up and please remember to subscribe if you're not already subscribed. Cheers, and I'll see you in the next video.